G'day everyone, welcome back to this series on covered calls, and as promised I'm going to give you an update about every month or so, or when there is activity in the options, so that you can actually gain a practical idea of how this works and how you can generate relatively consistent income over time. So let's jump in and have a look at what's happened to the two particular stocks that we're focused on, which is Apple in the technology sector and JP Morgan in the technology sector, in the banking sector. If you haven't seen the first video in the series, then please go back and look at that, and that will provide some more detail. So just a quick recap, on the 26th of June, we bought 100 shares of Apple at $146, which is shown with this little mark on the chart here. And at the same time, we sold to open 1 July $146 call contract, and we received $295 of income. Now the stock price went up, and so without taking any further action, the call option was what's called in the money, and therefore the stock was taken away from us. So we were forced to sell the stock at $146, which was the price that we paid for it. But we get to keep the income, the $2.95 or $295 per contract. So that gave us a yield of 2.02% for just under a month. Now, there are other options, but I won't be into how we could have dealt with this, but I won't go into that at this stage. I'll just keep it simple. So I wish to reinitiate now with Apple. And so on the 24th of July, I bought 100 shares at the current price of $150.58, and simultaneously sold 1 August $152.50 call and received again $2.90 or income of $290. So we'll let that run. That's got another 4 weeks to run, or 26 days. And we'll see how that pans out over that time. It doesn't really matter whether the stock price goes up, down, or sideways. I'm not particularly fussed either way. Now you could look at this first exercise with Apple and say, well, if I just bought the shares, I would have done better rather than writing a covered call. And that is true in this particular instance. However, what if the share price hadn't gone up? And in fact, the share price had stayed flat, or maybe it had even gone down slightly, then you would have made no money. So what you are doing is swapping the potential upside that the stock might offer for the greater reliability that's created by time decay. And that's essentially the strategy that we're using here. We're using the following tailwind, if you like, of time decay to help us make money. And we don't need the stock price to actually move to achieve that. Now, the second stock was JP Morgan, which is a $300 billion market cap bank, one of the biggest in the world. And again, just to quickly recap, on the 26th of June, we bought 100 shares and sold 1 July call. The price moved up in that period of time. So there is the strike of the call option. The price finished above it, which means the call option was in the money, and we were forced to sell our stock for $86.50. So in actual fact, we made a $36 loss on the stock, but we did make $167 worth of income on the call option. So without taking any further action, the stock was taken away from us, and on the 24th of July, I reinitiated by buying at the open price of $90.96 and sold a call option in August at $91 and received income of $155. So that's how it stands at this point in time, and when I make another change to these option series, then I'll update this video. That's all for now. Cheers.